the Monday Club are coming up, because that's when we normally do those exercises, when we try and get people's processing speeds up for the short-term scalping. It's going to be in the Monday Club exercises. So that's what we're going to be covering. We're going to build the chart out. We'll make sure you guys have got exactly the same chart, and we'll obviously do the exercise for perhaps an hour or two, and you'll get you practicing on the depth of market charts and stuff like that to try and see how you get on as a market maker scalper. Okay, so we'll basically do exactly the same exercise on Monday for about an hour, just to see how fast you can get. See how fast you can get as a scalper. See how you perform. See if you're able to perform. So that's what we're going to do this Monday coming in the Market Makers Monday Club exercise. Leans, more if you please. Leans. This was a classroom we did a while ago. And, and Kim said it was very important as a kind of standalone for people to just kind of go back a step on. And, this is just a screenshot from that classroom. So obviously screenshots get a bit messy at times because we start writing things that just because they're coming up in conversation or answering a question or whatever. And, Kim thought it was quite important, and certainly from some people that she's spoken to since, they've thought it was quite an important classroom as well. So it's something we want to just touch back on in kind of briefer terms this time. Obviously, we'll do a bit of time on it. As a trader, the most important thing in trading is that you've got something to lean against. You've got to have some sort of a some sort of background or some sort of a baseline. You've got to have something that's giving you to something, a fence post to lean against, an idea, a theory, a basis of your whole trade idea has got to have something that you can lean against. For some people, it might be a bit of order flow. It might be a limit order book. It might be a delta divergence. It might be an alpha line. It might be a key level from the overnight sessions. The question I had for everybody in the room a few weeks ago was, what is it that you lean against? And I want you to think about that question. When you're thinking about trading, when you're thinking about what you're currently trading and what kind of markets you're trading, what is it you're leaning against to get your trades on? What is it you're seeing, or what is it you need to see to get your trades into play? When we look at this, and we'll just kind of tick off the boxes, the first question is, do you even know what it is you're leaning against just now? In other words, if I asked you right now to show me a piece of paper that perhaps has all the elements that you need to see before you take a trade, are you able to take a trade based on what it is you've got in front of you? Is there something concrete, in other words, or is it just a vague idea? Is it just a vague idea that you've got that there's a trade setting up? Because that's a huge question, isn't it? Because for most people, even for probably a lot of people in the classroom here, they've got no idea what it is that they're leaning against. It's a hodgepodge of ideas that they come into their desks. And it changes day by day. Well, that's not a bad thing, so long as you understand that it is changing day by day, and you can obviously say, well, that didn't work, or that did work. The problem sometimes with that is that you're not getting the consistency. You're not really writing down, for example, what it is that you're able to lean against. And because of that, if you have a bad day and you think, what was it I was leaning against, to be honest? I look back at my charts, and you might do the same. You might look back on your charts and you say, what the hell did I take that buy trade for? As you well know, I'm not a great fan of writing out a journal. It doesn't seem to make an awful lot of sense writing out journals all the time. But when in the early stages of trying to form this idea of what it is I'm going to lean against, it's sometimes a good idea to take a note of what it was you saw at the time. Take a screenshot even. Print out the chart at the point of making the decision. So I saw this developing alpha, or I saw this order flow, or I saw this delta coming in behind us to take a deal. So therefore, when you're looking at what it is you lean against, I want you to be really serious about this. Really serious about this. What is it that you would lean against in the market you're trading today, and can you quantify it? I need to see oil prices going up against equities. I need to see the curve going down against bonds dropping. I need to see, these are all vague terms. They're all vague, right? And because they're vague, it leaves you with this indecision about what to do. This idea of anchoring, which has been mentioned before in the previous little classroom. How do we anchor that? What time frame do we anchor that against? How do we see value? How do I recognize what value is? So when you look at the anchoring process, yeah, of course, that's the point. This is why we bring value into line with volume and also into line with order flow. Because whilst you might see value as building, if nobody else sees value as building, what the hell's a trade, right? So that's why we did that little exercise as well, because if we go back now and I said to you guys, right, let's assume I ask you all, what is your lean? So let's do leans. What is your lean? And you say to me, right, if I get an uptick in value versus, say, a downtick in price, that's my lean. Now, that seems like a perfectly reasonable lean, doesn't it? Until something like this happens, of course, right? So here's your value line. So this is your value line here. And this is your price line. So what's your trade at the moment? Well, the only trade would be to try and buy a pullback, correct? The only trade would be to try and buy a pullback. So what happens when this happens here? Based on your narrative, I'll make it go up a little bit so that it's still in line with your narrative. Based on your narrative, are you a buyer? Based on your grey definition of what a lean is, are you a buyer on that narrative? Well, the answer is yes, you are. Because otherwise, that's all your narrative tells you, doesn't it, Stuart? I'm just asking, I'm not asking if you would be a buyer, really. I'm just asking you, based on this being your narrative, would you buy that black line? The answer is absolutely yes, because it confirms my narrative. But what happens if this happens? Are you a buyer? So you've already said that you're going to buy this one, and now you've said you're going to buy this one. So what happens if this then happens? Are you a buyer? And the answer is yeah. So this is the problem, isn't it? This is the whole point I'm trying to make. Having a vague lean that says if I get a little bit of value on the bid or the offer, if I get a little bit of value, I'm taking a buy trade or a sell trade, is far too vague. But it's obviously, you know what alpha looks like. You've just not been able to define what alpha needs to be before you become a buyer or seller. So when you're looking at this, what is the alpha? Assuming this is a measurable alpha, the alpha on this first buy trade is this amount of alpha here, isn't it? That's how much alpha you've got at that point. The trade here has this amount of alpha, and the trade here has this amount of alpha. Alpha is just the edge that you have over what you believe is fair value reading. So obviously, as a lean, just coming up with this idea isn't going to help you as a trader. In fact, it's going to probably lose you a lot of money because you're going to get gamed, you're going to get stuck, you're going to get in the wrong trade at the wrong price. And obviously that's something that you're just going to end up getting really frustrated with because you can see where the value is. So you've got to do better than that, haven't you? You've got to have some way at least of being able to value this. And the second question, of course, is, what happens if I zoom out of this chart? So we zoom away from that chart for a second. And what happens if this little move here? What happens if this little move in red, right? So that's that move there, right? From this starting point here to this finishing point. And then we've got that little move in black here. What happens if I zoom out my charts and that move in black, which is from here to here, turns out to be something like this on a bigger picture chart? So in other words, this phase in this chart here, when I zoom into the charts, this phase here is this phase here, isn't it? The red line is going up, which is what we can identify from this point here to this point here, is this point here to this point here. And the black line is going down, which is what we can identify from this point here to this point here, which is this point here to this point here. But because you have got this very short-term narrative, you could look at that and say, oh, I've got to buy into this. And yet, if you're looking at the longer-term narrative, you absolutely must be looking at it from a value perspective in terms of if this is properly scaled, that there is a very high probability that you should be selling the black line on upticks, not buying the black line on downticks. So context to this line is also important. So inside that lean, you've got to try and ask yourself the question, what is it I'm leaning against? Am I leaning against a 1 minute chart, a 5 minute chart, a 5 second chart? And obviously based on that lean, you've got to then say, well, do I need to see the longer term alphas? But then you've got to define what longer term alphas mean. It's no point in Francisco saying, yeah, I'm a buyer on downticks for the longer term without saying, well, what longer term are you talking about? For a 5 second market maker, they might be talking about the last 30 minutes. For Francisco, he might be talking about the last 30 days. It's a completely different picture that you're painting, aren't you? You're leaning against the last 30 days against the last 30 minutes. The levels are going to be completely different. The trades are going to be completely different. And the one thing we've got to understand is that that's going to cause us all sorts of problems to try and develop a narrative around. And this brings up the next big problem. This brings up the next big problem that you've got with any type of value trading, unless it's market internals. And that is that the bigger the alpha, the bigger the opportunity for a spread trade to take place. It's called double alpha, right? Double alpha. So what happens, of course, is imagine we were trading the black line against the red line. Let's assume, for example, one of the pairs trades that we look at all the time, and we actually were talking about it in a meeting a while ago, and I noticed somebody else started to mention this pairs trade, was comparing Tesla to NIO, because I was going to bring that trade into the room for Gene to look at, trading Tesla against NIO as a pairs trade. And obviously, one of the things you do as a pairs trade is you buy one and sell the other. But obviously, inside a pairs trade, you've also got something else happening. What else have you got happening inside a pairs trade? Let's assume, for argument's sake, you agree that the pairs trade of NIO versus Tesla is a good trade as a pairs trade. Let's assume you agree that they occupy roughly the same space, and therefore any value divergence gives us a possibility of an alpha-based trade, right? So you're creating alpha when these two trades separate from each other. But obviously in the background to that, what else could be happening that would give you a better idea about what's going on with that trade? What else? Must be something else, guys. The market, Stuart, right? The equity markets. Because here's the question. Is Tesla more likely to go up when the index is going higher? Is NIO more likely to go up when the index is going higher? Of course it is, right? There are buyers coming in for stocks. So therefore, inside of these bubbles, there is always another alpha line developing in the background that might help you with your analysis. So in the case of the likes of NIO versus Tesla, there may well be a bubble developing which says, well, the equity market is doing this. The equity market is doing this. So on a macro scale, the best trade would be to try and buy the red line on downticks. On the short-term scale, you could start watching for these buys on downticks on the black line just now, couldn't you? Short-term. But now you've got two trades on two different time frames. Now, obviously, the short-term time frame is more likely to happen in the short term. It's more likely to have short-term values. And this brings us to the next part. Just having this information still doesn't tell us. If that green line's going up and you say, well, I want to buy the market that's declining against that equity index rising, and this black line happens to be, say, Tesla shares against NIO shares, which is the red line, it still doesn't tell you whether you're going to buy this candle here, or this candle here, or this candle here, does it? It doesn't tell you that. So we have to then think about what it is we're leaning against. Otherwise, you could end up buying on a downtick and buying again on a downtick and buying again on a downtick and buying another downticking phase until eventually you've run out of money and the market's still going down. So there's going to be something else, guys. Well, you can see here, value, quantify, divergent over what period? What period are we talking about? How much divergence are we talking about? Do you have to have macro divergence in line with micro divergence? If not, why not? You've got to have answers to these questions. Otherwise, you're going to be making it up on the right-hand edge as you go along, Christian, aren't you? You're going to be making it up as you go along. You're not going to have the trade lined out. It's not going to be perfectly formed. You're going to be making shit up on the right-hand edge. And obviously, if you make it up on the right-hand edge, guys, what's the chances of you being long-term successful? You're going to get screwed, aren't you? You're going to get run over. Because you're making this shit up as you go along. Yeah, well, I kind of had enough value in the long term, or I didn't have any value in the long term. What the hell were you doing any business for? So there's got to be a way of trying to formulate. I'm not asking you to quantify how much value you've got. I'm asking you to think about what it is that you know as value. I want you to consider what you believe is a good enough alpha to buy into a trade or sell into a trade. And try and value it. Try and come up with a way, a process. How do you do that? Well, one of the ways you can do it, obviously, is to look at great turning points in the marketplace where you had that value and try and figure out how much value you had. That's one way you could do it. So that you start forming an opinion about what great value looks like. So hindsight analysis is actually really useful. When I look at the difference between the crack spread, for example, and I look at contract 1 and contract 2, we obviously know what the extremes are of contract 1 and 2. When I look at the difference between the 5-year Treasury bond and the 10-year Treasury bond, I can form an opinion by observation of the past, what the extremes in those Treasury bonds are, and I can use that extreme knowledge to trade properly. It doesn't mean it can't become more extreme, but obviously the chances are that when you hit into the extremes, there's always going to be that idea that there's always going to be somebody that's going to trade it back at least a little bit to give you a stop in a break-even position. So extremes are something you can lean against to a certain degree. So one of the other things we can start looking at is we can start asking, how much divergence do I have in the extremes? Can I measure it? Or at least do I know what it looks like? Does it make an awful lot of difference if I'm going to scalp a 1 second chart or a 5 second chart? Well, not as much. All you know is something that says something along the lines of, in the back of your brain, the bigger the alpha, the better the trade, right? That's obviously something that you've got as a bedrock that you can lean against. The bigger the alpha, the better the trade. And that's obviously got to be true. So how else do we answer these questions? The daily session divergence. I mean, is that a good enough time frame that you've got daily divergence on a daily chart, or a session divergence from the cash open or close, to be able to buy a discount or sell into a premium price at the top edge? And then obviously we've got the other things we can lean against. Now, this is not anything to do with the idea of the alpha that's developing, but obviously we've got other things we can lean against, and those things are things like levels. Obviously, you're looking at the liquidity that's coming in, the commercial liquidity that shows up. That could be liquidity on the limit order book if you've got access to limit order books. You could ask the question whether they're buying at higher prices. That's obviously a technical structure, isn't it? When they start buying at higher prices. But when we're talking about liquidity, what we're asking is really, are they adding bid liquidity into a market at higher prices? If they are, that's really got to be quite aggressive. The reason for that is, or should be, relatively straightforward. When we're looking at leaning against the limit order book, we should have a very, very simple basic metric in mind. And that simple basic metric is Sammy's favorite chart of all time. It's the supply-demand chart. Because obviously when we're looking at a supply-demand chart, we're looking at volume profile. We know that as a rule, the biggest selling opportunity should be here. The biggest volume of sellers should be at that price. As a rule, the biggest volume of buyers should be at this price. We can see that that's the case by doing the Economics 101 when we look at the supply-demand curve itself. When we look at the supply-demand curve, we know that it looks a little bit like this. This is what supply-demand curve looks like, right? And the mid price is obviously that price that nobody's happy with, but everybody at least agrees on, that it's about fair value for the buyers and the sellers. So when we reach up into the top edge of a market like this, who's unfair? Inside this scenario, who's unfair at this price? It's unfair on the buyers, isn't it? It's unfair on any buyers to step in at that price. Because you're way above fair value based on the technical structure here. So if it's unfair on buyers, no wonder you get a big drop-off in buying volumes at higher prices. Who is it very fair at the high price? Well, if it's unfair for buyers, it must be very fair for sellers, right? It must be very fair for sellers because they're getting a higher price. But obviously that means that there is an imbalance on the limit order book, isn't there? There's an imbalance on the limit order book. There's a lot more sellers than there are buyers as the price rises into the top edge. And obviously that's inverted for the other side. That's in the inverse for the other side. And that would mean that at this point here, the biggest balance is now in play. And this is where a lot of people get this whole thing mistaken. And I asked this question in Classroom a short while ago, and I think there's a few interesting exclamations about this point. We're talking about the balance area. Does the balance area have the biggest certainty or the biggest uncertainty? For the guys that just joined us for this week. The balance area, the biggest certainty, the POC, the biggest certainty or the biggest uncertainty? What is everybody's view on that? The balance area in the middle is the biggest uncertainty. And the reason for that is because nobody's sure whether it's a sell continuation or a buy fade or a whatever. Because most people, because they see it as fair value in the POC, most people in the retail space sees the POC as the level of the highest certainty. Is that reasonable? The POC is the highest level of certainty, is most retail trading public's perception of what a POC is. Well, they're all agreeing with each other. They're all certain. Everybody's certain around this area. Nobody's certain in this area, guys. Nobody is certain in this price. Because if you're certain of an outcome, the high probability is the other side is definitely uncertain of an outcome, right? So when we move to a top edge, the buyers are going to be saying, I don't know if I should buy at this price. So the buyer's uncertain, aren't they? And the volume in the buy side drops right off, and that's why we can see that they're uncertain. If the volume on the buy side drops off, the buyers can't be certain of the price going any higher. And obviously, if the seller's volume increases, they must be certain that this is a top edge. And that's what's called an imbalance. That's what's called asymmetrical order flow at that price. And as a result, the buyers say, okay, well, that little bit of selling causes the buyers to now definitely get a level of certainty that it's definitely not a buy trade. So the buyer said, now I'm certain this is not a buy trade, and the price sells off. When the price reaches uncertainty, the big challenge for the sellers now is what? So the price started, for argument's sake, here, and it's driven higher. But the buyers say, I'm uncertain of this trade, and the volume disappears. And the sellers say, I am certain of it, and they start selling at lower prices because they're certain at even lower prices. So the buyer says, to pot with this, there's no way I'm going to try and buy against this. I wasn't certain at the best of times, and I'm certainly not certain now. I'm definitely certain that it's a sell. But when it gets to this price, what is the seller's problem? How certain are you that it's a sell past that price? Now, obviously, the buyer's not going to step, and this is where a lot of people get this whole thing mixed up. A lot of buyers are saying, well, I'm not going to be first to buy it. I'm going to wait for somebody else to buy it, right? So the sellers and the sellers are going to take profits. The buyers who were in from an earlier trade down here, they're going to see the selling coming in. They're going to take profits. And this is why we get POCs. Everybody takes profits. Very few people take new positions unless alpha develops at these prices, right? You can take advantage of that uncertainty by becoming a buyer or a seller at these prices because there's wads of liquidity available. By becoming a buyer or a seller at these prices because there's wads of liquidity available. Huge amounts of liquidity at these uncertain price levels. Now, obviously, at this stage here, there's profit takers. But what happens? Why does the price not go up? Because there's nobody wanting to buy at that price. So why does the price keep going down? Because the price has been falling already. And the price isn't going to stop going down until a buyer starts. Now, a lot of people wonder about this. They say, but surely when the price drops, the number of sellers is getting less and less and less. Why does the price keep falling? And I liken it to an auction. So you go into a house auction or a car auction, and the car's selling, for argument's sake, the car's selling for $20,000. And you've done your research into this car, and you think the car's worth $35,000. You get the basic idea? So in other words, the car's valued at 35 grand. Now, if I look at this on this chart, for example, you could put the car valuation up here at 35,000. The auction is starting at 20 grand here, right? So there's the 20 grand auction. So you believe values are way up here. When that auction starts, though, are you going to start bidding 21? You've got 14 grand of profit. Are you going to bid 21? You're going to put your paddle up straight away and bid 21? Yes or no? No, why would you not bid 21 when you've got value at 21, I mean? Why would you want to bid? Why would you want to bid 21? You don't know where the bottom is. Do you agree with that? You don't know where the bottom is. You might get it cheaper, Tim, absolutely, right? So you're not going to bid 21s, and then the price drops to 19. You're going to bid 19s? There's a very good chance what's happening. There's a very good chance that there is thousands of buyers in the room waiting. There's a very good chance that there's maybe 500 buyers that think this car's valued at 35 grand, right? There could be hundreds of buyers that think the car's worth 35 grand, but the price is still falling. The price drops to 15. Still no paddles are going up. The price drops to 10. And all of a sudden, the first guy puts his paddle up. What happens after the first guy puts his paddle up, guys? Somebody says, 10. What happens next? 11, 12, 13, 14, 15, 20, 21, 22, 24, 25, 26, 28, 29, 30. And all of a sudden, as soon as one person buys it, the auction takes off, doesn't it? So it hits 10, somebody steps in with their paddle at 10s, and the auction rockets through to 30s very quickly. And a lot of people say, well, where were all the buyers before? They were just waiting. That's all they were doing. It wasn't that they weren't available in the marketplace. We can tell from Economics 101, as the price drops, the volume of buyers is getting bigger and bigger and bigger and bigger. All of these, the blue line here is the demand, right? The volume on those demand is getting bigger at lower prices. It doesn't mean they're buying it yet. It means that that pent-up demand is getting bigger and bigger and bigger as price drops. As soon as somebody puts up the bid, now everybody knows, well, I'm not going to get my lower price because the bid's now in. If the bid's now in, it's up to me to now decide whether I now have enough real money value to go in after the bid at 10s or 11s or 12s or 13s or 15s or 20s even. Well, that's all depending upon what your valuation is of the market, isn't it? Some guys might value it at 22. They would obviously stop bidding maybe at 17s or 18s. Some guys might value it at 25. They would stop bidding at 24s, 25s. Some guys might have a valuation of 50. If they've got a valuation of 50, you're not going to win that car auction, are you? If somebody's got a higher valuation in the car auction than you have. Because the price is going to scalp through 35, you're going to think about that as now above value. And unless you're obviously just got an ego of an absolute idiot and you can't be seen to be getting beer on an auction, you're not going to pay any more than maybe 31, 32, right? And obviously the price just keeps going up. So this is something you've got to remember. It doesn't mean there's no buyers when the price is falling. Because a lot of people, when they think about profile and they think about this Economics 101, they don't understand this. They say, surely as soon as the price goes below the 50 line, it's got to automatically go up because there's more buyers than sellers. There are more buyers than sellers probably at that price, assuming they all have the same idea about where the value is. But until somebody starts the auction, nobody is going to want to come in too soon. Because what happens? What happens if the price drops to 10? And nobody actually likes this car. If you're the only guy that likes that car, you're waiting and you're looking around saying, what the hell? And the auctioneer starts hitting the gavel, right? Going once, going twice. It's not going to sell unless you bid. Going once, going twice. And then you buy it for 10. You decide, okay, well, I'll put my bid in at 10. You buy it at 10 at the lowest print price, and you buy it. And obviously, if nobody else thinks it's got any value, then obviously you might have bought a lemon. Absolutely, Laurie. But it may well be that just nobody fancied it at that price, right? Nobody fancied it. Nobody was after that trade at that point. What is this buyer? You would be saying, and what? So what? What is this relevance? What is this buyer? Volume, right? When you see that buyer coming in for the first time at that bottom part of the auction, that's a volume surge. So all of a sudden, those 500 guys that wanted to buy the car at 10, there's 500 people that think it's a great deal at 10, all of a sudden, all their paddles go up at the same time instead of just one paddle. And obviously that trade starts big style. So the first guy puts his paddle up, the second guy puts his paddle up, the third guy puts his paddle up. 500 guys later, they're all putting their paddles up, trying to buy anything at those low prices. And that demand drives the price higher at that point. So the same is true when we go above the 20. Sellers have a decision to make. How certain is the value at 35? If they think the value is at 35, they're not going to start offering until the price is above 35, right? If you're a seller. Because obviously if the market thinks that that's the fair value price, then obviously informed buyers will come in at any price below 35, correct? But it doesn't make any difference. Because until that auction starts, it's not going to start moving. It's not going to stop dropping. And the auction can drop an awful lot longer, because what's the damage to you as a buyer of a dropping auction, guys? Seriously, think about it. You're a buyer. You're wanting to buy this £35,000 car. The auction's dropping. What damage is it doing to you when the auction's dropping? Zero. Zero. The price drops 20, 19, 15, 14, 12, 11, 10, 9, 8. It's not doing you any damage at all. In fact, it's doing you a lot of good the lower the price goes as a buyer, right? So it does pay you to wait, Laurie. As a buyer, it pays you to be patient and wait for the lowest possible price. It's pretty obvious, right? So this is incredibly simply powerful. This is incredibly powerful as a trader, because we wait for the auction to start, but the auction doesn't start until you see a big puff of volume. And that's what you see when we were looking at that S&P chart or that YM chart or any of the other charts. When you see the puff of volume, you start saying, oh, wait a second, I get that now. That puff of volume tells me that there is somebody coming in at the wrong price. Somebody coming in at the wrong price in the equity market. Somebody willing to pay more than they should for a bit of business here. Now, as I said before, I mean, I can look at I can give you a great example of that on that YM chart that I showed you earlier. Here's a great example. Take a look at that black line against the red line. Red line is alpha. Doesn't matter what it is, guys. That's not the point of this. If the red line is alpha and you accept that it is, the drop down here on the black line means nothing. Until what? So this could be the car at 20,000. This could be the car at 10,000. This could be the car at 5,000. This could be the car at 3,000. And then all of a sudden the paddle goes up right here, right? All of a sudden your paddle shoots up in the air. And there it is. Somebody thinks that that alpha now has a price that is almost unbeatable. Somebody thinks that there's enough value to load up the liquidity order book on the short side. And that causes a surge in volume on that trade. In other words, you would be selling the Dow Jones at that point. Very crystal clear, right? There's some of you might argue, but was this not crystal clear? When this dropped and that rallied a little bit, was that volume there not crystal clear for the same trade? Well, I don't know about you, but I don't really see an awful lot of alpha in that. And you might say, how do you know if there's not an awful lot of alpha? That's an experience thing. How would you know there's not a lot of alpha in this trade, guys? Here. How would you know that there's not a lot of alpha in that trade? Think about it. Why would you not buy that? Even if it was your rule, I'm going to buy the black line. If the red line's going up and I see an increase in volume, you'd buy that, right? But why would I not buy the black line at that stage? Why would I not be a buyer of the black line at that point? And you might say, because there's not enough alpha. But what makes you say that there's not enough alpha? Think about it. Come up with something solid here, guys. Come up with something solid that tells you there's not enough alpha on that trade right there. There's an alpha sell that's just came in right there on that blue line. That's a buy on the S&P, by the way. There's an alpha sell's just happened right there. If I said to you, if you buy that black line based on the previous volatility of the red line, is it possible, yes or no, that on the very next candle that you could have no value whatsoever based on the previous volatility? Is it possible that within 5 seconds you could have no value whatsoever? And there's your answer. If I look at the amount of value that's in here, and I see that the amount of value that's on this trade at that point is, say for argument's sake, this is anchored properly, that's how much value I've got at that point. You can simply look at the very short-term volatilities and say, well, one candle volatility is bigger than the amount of value you've got. One candle volatility, guys, is bigger than the amount of alpha you've got in that trade. Do you think that's ever going to be enough alpha to trade if you've got one candle volatility in your favor? It's hopeless, right? So when you look at one candle volatility, the very next candle could be a sell on the red line and your value's just disappeared within 5 seconds. So I don't think that, based on a very, very simple volatility narrative of alpha, I don't think there's anywhere near enough value to buy that black line or sell the Dow Jones at that point. There's not even close to enough alpha to take that trade, is there? But if I said to you on this trade here, have you got enough alpha to do that trade there? In other words, is there any chance that this red line could actually wipe out the gain on the black line inside of one candle? Probably not, right? It could do it. Of course it could do it. But is there a possibility that it's not going to do it? There's a higher probability that the value is not going to wipe out my entry price on that one candle. Now, it could do it in 2 candles, but that gives me time to, that buys me time, Laurie, doesn't it? It buys me time to make that decision. So when I look at that, I could say, well, you know, I probably have a solid enough decision to do a bit of business here, and I could sell the Dow Jones in that candle. What else gives me the confidence to sell the Dow Jones in that candle? The auction that starts at that price. In this case, it's an uninformed buyer. You can see that because it's a green candle. You can see it's a green value, which means that there must be an uninformed buyer at that price. So at this price here, I become a seller of the Dow Jones. So when we look at the Dow Jones chart, I become a seller of the Dow Jones in that candle right there at a price of 772s, right? So I've got a worst case scenario that I've probably got a 5-second window to see what happens next. And as it goes from 772s down to a low print price of 757s as a scalper on a 5-second chart. That's a reasonable trade. We make a reasonable amount of money on that bit of value, don't we? So that's how we deal. Now, obviously, what's happened since then is we've just seen a trade setting up on the S&P just there, and I shouted it just as I saw the volume. Is there anybody that doesn't see that volume? Is there anybody that doesn't see that volume as standout? Is there anybody that doesn't think there's enough value short term? Is there anybody that doesn't see enough alpha to go short on that blue line right there against volatility for, say, 1 candle, 2 candle volatilities? Is there, in other words, what I'm asking is there enough alpha on that trade there that's going to get wiped out in the next 5 seconds? Yes or no? There is more than enough alpha to take that trade on, isn't there? Just based on one candle volatilities, guys. But what are you starting to see when I'm talking about this? Tell me what you're starting to see when I'm starting to mention this. You're starting to see a definition of how much value needs to be in a trade. You see the difference? It's not just the blue line going up against the red line. We're now adding a volatility definition into your narrative, aren't you? That volatility definition, you might disagree with. You might say it's not enough for me. But at least you're getting a definition. So in other words, I could start looking at that and saying, okay, well, one candle volatility might not be enough, but that's my choice to make, isn't it? I don't think that's just one candle volatility. I think that's probably 2 or 3 candles of volatility, that size of alpha. In other words, I've started to define how much alpha I've got based on the volatility of the value that's developing. You can see, obviously see, some of you could argue, well, I see volatility that's in the background, the size, if this is anchored properly, there's a hell of a big spike in the red line over 2 candles there. Well, yeah, that's true. Those 2 candles would have taken out all of the value in that trade, but it wouldn't have made it negative. In other words, I could still, even if I got the worst case volatility over 2 candles that we've seen in that chart, I could still probably scratch a buy trade on the S&P at that point. I could still get away with a scratch trade. Reasonable? Damn tootin' right it's reasonable. So in other words, we've now defined what our lean is. It's not just a vague idea that we've got a lean developing. We've now defined our lean by including volume and volatility now, haven't we? So when I look at that and I say, well, what is that trade? Am I going to do a bit of business here? Yes or no? Well, let's take a look. We said that this would be a buy on this trade. Yeah, we talked about this idea of, you know, taking this bit of business in here. We talked about this trade here. So this is going to be a buy trade on the S&P, isn't it? On the end of that candle. So let's take a look at the S&P and see if it was a buy trade at the end of that candle. There's the S&P right there. You see it? So there's your buy trade opportunity on the S&P at that point. It was live and you saw it developing in the room just as it happened right there. There's the trade. It's at a price of 59 3/4. You see it? It's at a price of 59 3/4. It rallied up to a high price there of 62.5 at that point. So you can see that defining this lean can actually start providing you some incredible entry processes, can't it? Just by being a little bit more specific, Laurie, not by having this vague notion that if this line goes up and that line goes down, then I've got some idea that there's some relative alpha forming. Yes, of course there's relative alpha forming, but have you got enough of a definition to tell you how much alpha you've got? Had we decided to do that trade in that earlier process, for example, on the Dow Jones here, because one's going up and one's going down, I would have been doing a bit of business here. I would have been doing a bit of business perhaps here as well, right? So based on those 2 elements, you can see what would have happened if I'd sold the Dow Jones on these 2 arrows here. I would have sold the Dow Jones here. I'd have lost out on my money. I'd have sold the Dow Jones here. I'd have get stopped out again for a second time. So in other words, that vague notion of the lines going in opposite directions, albeit very briefly, doesn't give me anything. It doesn't give me any weight. It doesn't give me any strength. It doesn't give me any particular confidence. It's starting to build my confidence It's starting to build my confidence that perhaps there's a trade, right? It's just building that. That's all it is. I'm starting to get more confident that a trade is setting up. And once I start seeing enough alpha based on volatilities, based on whatever measure we're using, one candle, two candle, three candle volatilities, based on some measure of volatilities, I can now define how much alpha I need to get, followed by a definition of volume. Because whilst we talked about that being a large volume candle, I don't think anybody's going to dispute that. Talked about that being a large volume candle, I don't think anybody's going to dispute that. But some of you might dispute this as a large volume candle, right? Some of you might look not at this trade here, not at this trade here, but because obviously we never had any alpha available on those trades. But some people might look at the volume on that candle and say it's not enough volume. Well, what volume do you need? How much volume are you going to wait for before you're going to believe it's enough? Because obviously you don't dictate how much volume comes into that, because the uninformed traders dictate how much volume comes in here. So that we already know that this is an uninformed buyer. But what happens if there's not a lot of buying coming in there? Are you going to still take the deal? Well, you've got to make that decision. You've got to make that decision as to how much volume you need to see to happen into a trade. Now, if the volume is very small, then obviously the chances of you getting your limit order sell filled is going to get less and less and less. We talked about creating edges using limit order book narratives in the classroom yesterday. So this idea that the volume is very small is pretty vague. It's pretty vague. So we've got to try and be a little bit more specific inside of our definitions, haven't we? So this is a great starting point, isn't it? It's a great starting point for understanding some of these ideas, to understand some of these narratives. So one of the things we can start watching is, can we see some of these elements? Have we got enough volatilities? Have we got enough trades? I mean, there's a great example there, isn't there? Does everybody see that as an uninformed seller coming in the Dow Jones, yes or no? Has that got more than one candle alpha available for a trade? So in other words, if we're now defining our value in terms of alphas against volatilities, Laurie thinks that we're getting enough alpha. Is that it? Does everybody else think we're getting enough alpha? We've got 170 people in this classroom, and there's one person who thinks there's enough alpha in that trade to take a deal. Okay, that's okay. Just a decision, right? It doesn't mean that 170 people think there's enough alpha. It just means that one person or two people or three people think there's enough alpha to take that bit of business. But the point is, whether you think there's enough alpha or not, that volume suggests that somebody in the institutional space thinks there's a hell of a lot of alpha. Do you see what we're saying now, Tim? Somebody in the world of institutional trading, because of that big surge in volume, believes that all of these sellers are absolute numpties. Correct? Everybody that's selling on that alpha must be an absolute numpty, because the buyers are now in business. So what's going to happen to the Dow Jones at that point? We all know what's going to happen to the Dow Jones at that point. It's almost a dead cert what's going to happen to the Dow Jones. If you've got all these uninformed sellers with that amount of volume, which means that they must be absorbing an awful lot of selling coming in, it means that the institutional buyers must love the trade. So there's your buy trade in the Dow Jones. And you might be saying, where's my buy trade in the Dow Jones? Well, here's the chart for the Dow Jones coming up. Does anybody see the buy on the Dow Jones now? Does anybody recognize that as a crystal clear buying opportunity on the Dow Jones at a price of 737? And what happened to that crystal clear buying opportunity at 737? It rallied up to 757. Bearing in mind, guys, that this is a 5-second chart. In other words, you made 20 ticks inside of 1 minute. 20 ticks profit on the Dow Jones on a one contract basis inside of 60 seconds. It's pretty good, right? It's a pretty good little trade. So obviously we can see that it's a pretty good little trade. We managed to get a good bit of business off of that trade narrative. And there's the money. There's the money shot right there. So this is the whole point about these aspects, isn't it? This is the whole point of trading. We're trying to figure out all of these elements. That's very visually, clearly value in that trade at that point. And it's backed up by volumes. Is this could this have been a possible sell trade here? A buy trade in the Dow Jones on the right-hand edge. This is live now, guys. This is live on the charts, as you can see. Not that line, sorry. It's ticked along there, so I missed the line. On that candle there, could that have been a possible buy trade in the Dow Jones, yes or no? Was there enough alpha to give you a relatively safe trade? Now, this is obviously a debatable question. I'm sure some of you might think it's maybe just a little bit skinny for an alpha trade. And some of you who are a little bit more aggressive will say, well, you know what? With a surge in volume like that, yeah, I think there's enough alpha in it. But whose decision's that? It's just a decision, isn't it? Would any of you have taken a Dow Jones buy trade against that alpha? Curious, guys, just curious. With this amount of alpha available, is that enough on a one candle basis to take a buy trade in the Dow Jones? Anyone? Anybody like it? Anyone? I thought a few people would have liked it. I quite like it because it's more than a candle. I like these one candle scalp type trades. So obviously what happened on the Dow Jones at that point, obviously I'm a buyer of Dow Jones. I'm going to try and bid into Dow Jones at lower prices at that stage. The volume's okay. It's not bad. I think we'd all prefer it to be better, slightly better than that one, right? We'd all prefer to get a little bit more value, but it could have been a trade, right? It could have been a trade. When we look at the Dow Jones from that point onwards, you could see that the candle actually gives you a couple of ideas, and ultimately what happens is you get a bit of an upside movement. You start making some monies. It's not a great trade, guys. I'm not claiming it for 1 second that it's a great trade, right? But that's why I'm saying it's open for everybody to observe and try and figure out whether they think there's enough value for the trade to happen, right? Whether they think there's enough value for the trade to happen. That's the question you're always asking when you're looking at these charts, isn't it? So when you're looking at screens, trying to define value can come from things like volatilities. This idea of using volatilities and volume to lean against comes back to this narrative. How much value have you got in this? If you're struggling to value that, wait for the auction to begin. When the auction begins, you've now got a definition that some institutional trader believes there is enough alpha to do business with. Well, who are you or I to disagree with that? If somebody is willing to put 100 contracts in the market in real time against that alpha, is that not a strong piece of information for you to do a bit of business against that 100 contracts? Of course it is. So when we come back to this original slide and we ask the question, how much alpha do you have to lean against? We can now define this idea of value as an alpha volatility volume equation, can't we? We can start getting a little bit more specific instead of having these very gray areas. When we talk about volume, we're obviously asking the question, how much volume? When you've got an indicator on your charts, when we're looking at block trades on gold or oil or anything else, that's obviously, depending upon your settings, of course. That's up to what settings you use to define whether you've got any block trades. It's not that there isn't any block trades. It's just that your volume settings are different, right? So when I look at the S&P in terms of block volumes, and we look at a chart like this, and I say, do you see any block volumes coming into the charts? Well, it all depends what my settings are. User-defined settings. So you can see that there was some ICE orders coming in here, but there was heavy selling coming in behind the ICE orders, so there was no real refreshing order book in here for the S&P to start rolling back off these. So one of the things you can start seeing, for example, is that big block liquidity there with this huge order book that was already starting to establish on the offer. And that became a great selling opportunity against a volume that was user defined. So if I looked at that, I could say, well, I'm starting to see a lot of selling coming in. You can see that selling that came in there created this pink candle right there. And obviously when we saw that big absorption print of that delta, and then you see the selling coming in behind the selling order book, you know the price is going to fall at that stage. But by then it's obviously quite a distance on the downtick. So you'd have to cross the spreads to get some business done. And obviously the sell-off was reasonable at that stage. You can see that this is still coming back into this big order block at the top edge here at 65 on the S&P at the moment, 65 on the S&P at this present moment. So you can start watching this 65 on this trade and you can start asking the question, am I starting to see any alpha developing? Am I starting to see that trade? Has it got something for me? Now obviously that's going to start becoming a burning question that you're starting to see an answer to. I see that the value started to evolve on that higher price just there. Look. See that candle right there? You see it? There's your trade, isn't it? Now you might say, that's not a trade. Yeah, based on your valuation of volatility, right? Based on somebody else's valuation of volatility, they might say that that is a trade, because obviously it's up to you what your volatility valuation is. Everybody's going to be different. But that is where, if you were wanting to get a sell trade against perhaps some other alphas, if I zoom out a little bit and I take a re-anchoring of this, is it now a trade? Well, the answer to that question is obviously now changed, hasn't it? So if I looked at that alpha and I could say, well, is that a trade there, guys? If that is how much alpha is available, is that enough alpha to do the business based on that huge surge of volume? And the question is, are you happy with it? And the answer is, yeah, maybe. So based on that trade, what are you going to do? You're going to sell the S&P, right? So what is the sell on the S&P? Let's take a look at the S&P on that big volume candle. The S&P sell was that candle right there, wasn't it? So that trade is going to be at 65.5, 65 3/4. So you can now see that trade, right? But that's not all you see. At 65.5 and 65 3/4, what else do you see? What else do you see, guys? 65.5 and 65 3/4. You see this big liquidity order block right there. We don't get a big surge in volumes that shows up as a block volume. You see this huge delta. You see that huge delta appearing. But obviously tying everything together, there's your sell trade. Agreed? That was your real-time sell trade on the S&P right there. If you decided that there was enough alpha available for that short trade to work. So based on enough alpha for the short trade to work, that would have been your short, and this is the current 1 minute chart that's giving you your profit right now. A real-time money trade on the right-hand edge of your charts. It's a pretty good trade outcome, isn't it? So defining that process enables me to make a decision about what I'm seeing. Just allowing me to look at this lean process, just looking at this idea of the value, the volume, allows me to start adding all these other elements to my trading. The limit order book, how much limit order book do I need to see before I start selling into that S&P top edge? In terms of the time of the day, obviously that's going to bring volume surges. So I've got to make sure I bear that in mind when I see a big volume surge coming into the markets based around the time of the day. When I look at the Voltic indicator, which you may or may not have from your Sierra charts, David's developing a package on NinjaTrader for Voltic to be on NinjaTrader as well. That basically tells you that there's an increase in activity on NinjaTrader or Sierra charts, which also can point to the possibility that the institution is already taking note of an alpha that's showing up. Remember, if a big volume comes in, you've got to take a second look at it, Laurie, because whilst you might disagree that there's enough alpha, for example, on that last sell trade on the S&P, you might disagree that there's enough alpha to take the sell trade. Somebody disagrees with you because somebody's doing the deal. There's actual real money doing the deal in that sell trade on the S&P, wasn't there? And that's what's resulted in that beautiful little sell-off there. It's not a big sell-off. It went from 65 and 3/4 to a low print of 63 and 3/4. In other words, it only moved 8 ticks profit, but 8 ticks is still 8 ticks. As a scalper, that's a pretty good profit, right? So whilst you might not agree that there's enough alpha, somebody disagrees with you, and you've got to make a decision whether you think it's acceptable to then join in the trade. If you do, you join in the trade. If you don't, you pass and you wait for your trade to set up, right? But at least you're now able to make that decision. That's the point. At least you're now able to make the decision that you can see somebody else likes it. You might take a second look at it. You might take a third look at it. You might take a slightly longer term look at it. You might look at it from the perspective of a different alpha to see if there's a reason why that person liked that sell trade a lot more than you did. And obviously based on that, assuming you do that very quickly, of course, you can join in the trade. You can take a trade idea based on that idea developing from the volume and the small amount of alpha that was visible on that one screen. So when we add all these other elements into the picture, into the melting pot, you can make short-term decisions against long-term backgrounds. You can make long-term decisions against short-term backgrounds and long-term backgrounds. But it's all coming down to this idea of being more in tune with exactly what it is you need to see. And we're going to be finishing off Classroom at this point. And the very simple fact is, sorry guys, it's just I've got a bit of a sore throat, and we'll finish off relatively quickly here. But the point is that the vast majority of you guys are not being specific enough about what you need to see. And because of that, it's leading you to make rash decisions too quickly at certain points. Your views are not formed enough. You're not waiting to get enough leans on your charts to make a great trading decision. The better you get at this process of defining exactly what it is you need to see to be a trader on a buy or a sell, the better you'll become as a trader. It's pretty much simple as that, isn't it? If you're making it up as you go along, your results will reflect that ad hoc kind of a random way of valuing a marketplace. If you've not really got into the idea of process, if you've not really encountered this process before, if you've never really developed any idea about leans, you're probably still making horrible mistakes anyway. So when you think about your markets, you start to think about this whole process better now, don't you? You're starting to give yourself a better way of considering whether you do or whether you don't have any value whatsoever. And just because you don't think there's enough alpha, if somebody does think there's enough alpha, there might be an opportunity. So for example, if I go back along to the S&P, for example, here, you might be thinking there's not enough alpha for the blue line against the red line. But somebody thinks there's a lot of alpha here, doesn't he? So if somebody thinks, because you can see the volume in the background, of course, guys, look at the volume, it's huge. But if you're looking at the value in that blue line, what about the alpha against that purple line? Have you ever thought that there could be a company or an organization, I'm just going to say a bank, an algorithm that is actually looking at the purple line as their alpha? Well, who looks at the purple line as alpha, guys? Index arbitrage traders. In fact, if you're talking about, therefore, the purple line, it's probable that the purple line divergence against the blue line is just as big a trade as the red line. Because the index arbitragers are going to sell some S&P at the same time as maybe buy some NASDAQ, for example. They'll maybe sell some S&P and buy some Dow Jones as an index arbitrage type trade. So when you see that huge volume, remember what we said about that huge volume. Somebody likes it. You might not agree, but it doesn't make any difference. You should still pay attention to the fact that somebody really likes this top edge on the S&P, guys. So when you look back at the original trade, which was this one over here, remember, this is where we talked about it originally. And we said, well, there's your deal. somebody loves the S&P on this trade right there, and somebody really likes the S&P on this trade right there. There's actually some sort of alpha on both of those trades. The alpha on this trade was against the red line and the purple line. The alpha on this trade is against a little bit of macro divergence against the red line and an awful lot of macro divergence against the purple line. So this could be a genuine selling opportunity on the S&P, right? So when I get rid of those lines and I say, well, how would those have performed if you took those two trades as sells on the S&P? How would those trades have performed? So you would have sold on the S&P on this candle here, and you'd have sold on the S&P on that candle there, wouldn't you? At the close of those two candles, you'd have taken short S&P trades. And obviously what happened next to those two sell trades? Well, those two sell trades are those two top edge sells that we saw that big liquidity showing up on. So you can see it's not necessarily about one line that provides an alpha read, it's about possibly two lines or possibly three lines. Just because there's a big volume draws your attention to the fact that somebody really likes it. That somebody doesn't have to be you, Laurie. It doesn't have to be Francisco. But you should at least pay attention to the fact that somebody somewhere on the planet likes it. And that somebody is significant. That somebody is putting real money at work. Not some lagging indicator that you get some crappy MT4 platforms or something. But that's real money that somebody is putting on the line because they believe that there's enough alpha to do a bit of business on the short side of the S&P at that point. You don't have to agree with them, but you should at least give them the credit that if they're going to trade size, they probably know what they're doing. And that's going to give you enough emphasis on the trade to at least look into it, right? It's going to emphasize that there is definitely a deal to be had up here. Now, you might argue, well, there's another one. There's another one. Are they doing it again? Are they doing it again? Well, we can obviously look at whether there's any value in that candle. Again, and we can ask the question, well, is there any alpha available on the deal? Let's take a look. Is there any alpha available on that deal? Well, short term, again, the value is going up again here. So, but the value in the purple line is now getting pretty much nothing, right? So I don't really like that as a trade at this point. I don't think that's got good enough alpha to do any business against that, the fact that we're now getting quite a sizable. Remember the last time we had quite a sizable divergence creeping in here. This time this all looks as if it's parallel shifting to the downside, so I don't think there's any value in that trade at all. I don't think there's any value. If there's any value, it's probably somebody that's decided to do a bit of buying on the likes of the NASDAQ, I think, at that stage. It looks more reasonable to buy the NASDAQ against what's happening. So obviously that to me isn't a trade. Now obviously this might start developing into a trade right here. See it? Right now at the right-hand edge, there's a possible sell trade. The alpha's got a lot better on that trade right there, hasn't it? Right there. So there's your sell trade on the S&P at the top of that candle. Let's see what's just happened on the S&P at the top of that candle. And you can see that in real time. You can see that the price that was traded there was 66 time. You can see that the price that was traded there was 66s. The price dropped down to 65.5. It's now 65.25. So you got filled at 66s right there. It's just traded 65.25. You've just made 3 ticks. It might not seem like a lot, but obviously every trade starts with a 1-tick profit. And obviously as a local, as a scalper, 3 ticks is actually a brilliant trade for most scalpers. They'll be delighted to make 3-tick profits on those types of deals, right? If it breaks south, you're in shape, you're in great shape. If it breaks north, you obviously get flattened out on the trade. At a stop at break even, there's your entry price. And obviously the lowest it went is 65.25. It still did 3 ticks. So the worst case scenario is you wouldn't have lost any money. The best case scenario still is, well, we don't know what the best case scenario is because we're not looking at value at the moment to see if value is improving or decreasing. We don't know that because we're not looking at that. but you get the basic idea of how this trade evolves. This trade here was exactly the same price, interestingly enough, as what? The last trade here was exactly the same price as the last trade here. So when we see these algorithmic trades setting up, the last time we did any business was here. Then we did business here. Look, see what's happening? And then we did business here. See what's happening? They're all the same fecking price. They're all the same price. So this is something that you're starting to see now, aren't you? You're starting to see this idea. Wait a second. We've just sold an algorithmic sell at the top edge of the S&P once, twice, and then 3 times. We've made money on the first one. We've made money on the second one. And we're currently making 4 ticks on the third one. And you could work some bids or offers against those ideas, couldn't you, on any kind of levels? And obviously, if the market breaks for $1,000, it breaks for $1,000. It might not do anything. But obviously, that's up to you guys if you fancy looking into those types of trade narratives. So when we look at this idea of leans, and it's just broken south a little bit there, guys, so that S&P short trade has just gone south. Guess what? Live in the room on a recording, it's just gone south, guys. Beautiful, right? Look, our S&P short trade off 66s has just traded 63 3/4. It's crazy good, isn't it? Live in the room, you just saw it happening. You had to make that decision. And the prices dropped beautifully down to 63 3/4 for a reasonable scalp profit for a local or a scalp trader. But you knew it was going to work out. You knew it was a high probability trade because you've already done the trade at that same price twice before. It's a brilliant example of how this process works over and over again. I mentioned earlier about doing this trade, possibly as much as several hundred times today, and it's always profited by at least something. Sometimes it just gives you a +1 in a scratch trade, and that's okay. So when you're thinking about leans, guys, when you're starting to look at your charts, and I challenge anybody to look at your own charts and think, what am I leaning against? And does it have any reason to be lent against? For some traders that don't use this room, they'll say, well, I'm leaning against an overbought stochastic or an oversold stochastic. What the hell is wrong with you? Why would that provide you with a lean? Is there an actual real money seller who's coming short the stochastic at 80? Seriously? There's a real money seller coming in short stochastic at 80. That guy's going to make a lot of money most days, isn't he? It's going to go 80s. It might go up to 90s. He's got a top side of 100. So if you sell stochastics at 80 and 90 and the 100, you're going to pretty much guarantee you're going to make a lot of money, right? So you can't lean against a stochastic. It's overbought. No, it's not. You've got to try and make sure you understand this idea of value in alphas. The idea of unfair highs and unfair lows. And the idea of having an idea about what the certain buyers and the certain sellers, or the uninformed buyers or the uninformed sellers are, allows you to make great trading decisions. It allows you to see the market in the way that institutional traders see it. And it's all being defined by all of these different kinds of leans. You can lean against the limit order book because that's real money. You can lean against deltas because that's real money. You can lean against volumes because that's real money. You can lean against levels because levels is volume. You can lean against Voltic because that's real trades. You can lean against some price action because usually price action requires volume to develop into a price action candle, like a Marabuzzo type candlestick formation. And that's what we've got to try and see, guys. So I think what we'll do at that is just finish off today, call it time on a 2-hour classroom, and we'll come back to it again tomorrow, guys. So let's finish off. I'm going to say thanks very much. I hope that's of some interest to you. And I'm going to say see you in the morning. In the meantime, guys, ciao for now.